Alright, welcome to this particular video, and in this video we are going to be talking about supply and demand. So this is a particular trade I took, a setup I took on BNB Binance coin. I think last 2 weeks or last week or so. Yes, it should be early last week, and it played out well simply because I made use of a valid order block, liquidity, change of character or break of structure. I worked with market structure, liquidity, supply and demand. So these are the three basic concepts I work strictly on: market structure, liquidity, supply and demand. So I'm going to explain how I was able to mark my supply zone here and place my entry on it. So um, let's go straight to the video now. So this is a setup I took on BNB. I took a shot on it from the supply zone there. Now I told you that if is a supply zone, how do you get your order block in a supply zone? Is to use the last candle before the drastic push to the upside. You can see this is the last candle here, that green candle, before this momentum red candle push to the downside with some a little sideways movement, then a continuation to the downside. We now formed a new lower low here and all that. So let me explain. In a bearish scenario, that is in a bearish order block or in a supply zone, you use the last candle before the drastic push to the downside. Now the bottom of the last candle, which is the bottom of this small green candle, and the top of the third candle, this is the first candle, this is the second candle, which is this big red, and this is the third candle, which is this dodgy rejection candle, whatever. So there must be a space between what the bottom of the first candle in a bearish order block or in a bearish scenario, like in a supply zone. How do you get your valid supply zone? Yes, how do you get your valid supply zone or valid order block in a bearish scenario? Is to look out for a change in the trend or a break of structure, and look out for the origin that caused it. Now once you find the origin that caused it, now you have to look out if the order block is a valid one by looking at the first and the third candle. Now you can see here that the first candle, that is the bottom part of this green candle, and the bottom part of this green candle here, that is the lowest point of the first candle, and the highest point of the third candle did not meet. There is a gap between the lowest point of the first candle and the highest point of the third candle. There is a gap that both candles left on the middle candle. So that is a clear sign that there is an imbalance there. The market will come, even if it goes down, it will trade upwards, fill that imbalance. Now I saw that and I marked it. So the reason why I marked it from this other big green candle is because this candle here is also within that region. If I had used this last candle, the other block rectangle will be too small, that this other block I wrote, this OB I wrote on it, inside it won't show. So this is another way again. You can use, if the candle is too small, you can just use another bigger candle, but make sure that the candle is within that range that your last candle is. So I just use this green one there and marked it as our other block. Then I saw this swing high liquidity. Yes, because market will kind of induce trader that, okay, since market came here, rejected price and kind of moved downwards, sellers started dominating, moving downwards, then it came up here again, moved downwards a bit. So they will not think that, okay, if the price should come back here again, from here it also went down a bit. if you go down to the lower time frame, you see that this small move on this 4 hours time frame is a bigger move on the smaller time frame, like 30 minutes, 15 minutes, or 5 minutes. So traders now would like to take a short from this rejection area, short position. Now they would like to take a short position from this place. Let me mark it here. Then they'll put their stop loss. Then they'll put their stop loss above a bit above that zone. You can see the stop loss now is kind of a bit above that equal swing high liquidity, and as you can see, so they will kind of want to take the market to either this point or this second point that I used on this particular trade. Though maybe some of them would like to use here, for example, now. But unfortunately, what the market do, market deceived most of them that might have seen this area as a supply zone to sell from. So it went there. Maybe some of them might have taken placed a sell limit order there. So market trade through a bit, then it went up, it triggered their entry, but instead of reversing to the downside, it went up, triggered their stop losses. That is, they sold back to the market for less that they bought the coin initially. So in the liquidity videos, where we talk about swing high, swing low, equal high liquidity, you can see that in this scenario now we have a perfect example of a swing high liquidity. And once you see something like that, it is not on that particular line that the liquidity is lying, is a bit above it, just a little bit above that zone. That is where the liquidity are lying, waiting to be filled, waiting to be triggered. So you can see market triggered their stop losses, took them out. Now because of the lots of stop losses and orders that was triggered here, market took enough liquidity from their stop losses. As you can see, it left that particular area with a wick. That means a seller started dominating and pushed market downward up to this our take profit level here. Why? Because market absorbed so much liquidity from the stop losses of those breakout traders, candlestick pattern traders. So it collected enough liquidity, and market move based on liquidity. So after collecting enough liquidity from their stop losses, it started trading downwards to the downside. And once it hit this particular liquidity area here, this particular area here with a wick, it started going up again. It started going up and started going up again. Now I want to show you another scenario of a short example. From this 4 hours time frame, I can see a supply zone being formed again. If I had opened this trade earlier, I would have cut the trade. So we can switch. Let me go down a bit in time frame to the 1 hour time frame. You can see yes, now you can see that market is still printing lower lows and lower highs even on the 1 hour time frame. That is to say that we are still bearish in this scenario. There is lower high, lower low, lower high, lower low, lower high here, lower low to this point, lower high here, then lower low to this point. Then we went up here, we broke this last lower high. That's a change of character to the upside. But instead of coming down a bit to break this high, we came down and took this very low, this low here. We broke this internal structure here, this little internal structure that I'm putting this black line on, this wick, this green wick, market came down there, broke it. That's a change of character. Yes, we first of all change the character to the upside, but we didn't continue the uptrend movement. We came down and reversed to the downside by changing character, by taking out this last higher low. So market from there started going downwards. Now what you have to do as a trader is this this um this this zone here, that led to this change of character here. Let me even mark it out. We change character here by breaking this last higher low with the body of a candle. Now you can see we have seen a change of character and also followed by a break of structure. Now we have seen two lower lows. We have confirmed that yes, we are now in a bearish movement because we have seen two lower lows. This is the first one, this is the second one. We have seen two lower lows now, and this is the last lower low that the market has left, that should be broken if we are to continue this trend. If the market continues printing lower lows to the downside, then we have to use this place as our take profit, because market should trade through and break this last lower low. So what you have to do is you have to look for the zone that led to this change of character here, that broke this last higher low, because we first of all changed character. We changed character here. We were bearish all along, all to this very moment that we took out this last higher, this last lower high here. We changed character there. So from there we went up. Instead of continuing the trend, we came down and broke this last higher low. We broke this last higher low, now becoming lower low. We came down there from this lower low here, then from this lower high, then we came down, broke this with the body of the candle, and left this lower low here waiting to be broken if market should continue printing lower lows to the downside. So now what you have to do is you have to look for the last. If this trade has not triggered yet, what we are going to do is the order block that led to this change of character is what we look for. And how do you look for bearish order block? Is the last candle before the drastic push to the downside is what you have to look out for. The last candle before the drastic push to the downside, which is this very red candle here. This is the last candle before this drastic push to the downside, and as you can see, this the lowest point of the first candle there and the highest point of the third candle did not meet. It's a huge gap between the two candles that left a gap on the middle candle. So what you have to do is you have to use your rectangle to mark the highest and lowest point of that candle as your bearish order block. The highest and lowest point, you mark it as your lowest point. Now you can see the imbalance there also. There is an imbalance here that market should come and fill. If this this market has not yet triggered yet, this is the imbalance that price will come and fill, which is the fair value gap or imbalance. Now if you are to take a short on this trade, now if you want to short this coin now, this is how it will look like. Your short position 2, then you put your entry at the point of that, the lowest point of the first candle, which is the last black line of your rectangle 2. You set it like this, then you put your stop loss above this. You put your stop loss above that the highest candle there on that other block area there, you put your stop loss somewhere here like this for a safer trade. Then you put your take profit. You put your take profit at this very lower low here to break, for market to come down, break this last lower low, thereby taking you out on your trade. And this is a 4:1, that is 1:4. Whatever amount you are risking on this trade, you are making times 4 of it. If I had caught this sell earlier, then we would have been in profit by now. As you can see, it's still going. So that is for a supply zone, and I believe by now you must have been getting some insight and understanding about a supply and a demand zone. So let me invert. You can see even on the 4 hours time frame, we are still time frame relevant, because if I had caught this sell on time, this would have been the second time I'm hitting this coin. So let me invert the scale to explain demand zone. Invert. You can see if this would have been a bearish movement, don't mind the figures on the right hand side, because I turned the chart upside down. So if this would have been a bearish movement, then all along you can see from this side we're coming down, printing lower highs and lower lows, lower highs and lower lows, until this very moment here. This is last lower high there, because it's lower than this high. Market came down here, from this last lower low, from this last lower high, because it's lower than this one. It came down. Instead of breaking this last lower low to continue trend, it didn't. Then market went up and broke this last lower high. And once you see market breaking the last previous lower high, that's a change of character, and it broke it with the body of a candle. Very strong indication that we have changed from bearish to a bullish. Now it went up there, it didn't close this high with the body of a candle, but instead it's a wick. And once you see something like this, is a liquidity graph. That's why I mark it as X, liquidity graph. If the market would have broken, if the market broke above this high here with the body of a candle, that is a break of structure. But now it is with a wick, which is liquidity graph. Immediately market went up to that very point, it started sellers started dominating over the buyers, and you can see it's a rejection wick. So since it was at this moment that sellers started dominating and left this high here, it is a good place to set your take profit, which is what I did. And once market immediately market hit that zone, it started coming down again. So that's for demand zone. And you can see once we broke this last lower high here with the body of the candle. Now what I did was that, what you have to do now is that you have to look for the other block that led to that change of character, because a valid order block must lead to a change of character or a break of structure, like I said in the previous videos. So in this scenario, this is the last candle before the drastic move to the upside. It's supposed to be a green candle, because I turned the chart upside down, so don't mind what you're saying, just try to understand the basic terms I'm explaining. So this is the last, like as I said before, this is the last candle, and this is the third candle. They did not meet, they left a price gap on the middle candle. So that is another criteria that this is a valid order block. There is an imbalance there on between the highest point of the first candle and the lowest point of the third candle, and it broke this structure by changing character to form a new trend in the market, which is uptrend. So a valid order block must have an imbalance, that is an inefficient market or an imbalance or a fair value gap, and it must lead to a break of structure or a change of character, which we are seeing in this scenario. So what you have to do is, and also there is a liquidity above the other block there. This is a swing low liquidity. In a bullish scenario, is a swing low liquidity. Any liquidity around your bullish order block, like the market is bullish, is either is an equal low liquidity or a swing low liquidity. It's only in a bearish market that you will see in a bearish market is you will see a swing high or equal high, but in a bullish scenario such as this is is an equal low or a swing low. So in this one now we have a swing low liquidity that some traders will think, okay, this is a very good point to buy from, stop losses around this zone. Then market will just go and sweep their stop losses, take their stop losses as liquidity to push market prices up. And market move based on liquidity. Once it taps and clears out their stop losses, it now have enough liquidity to push market to the upside to break the last higher high it left, which is where you set your take profit, because there's a high probability that market to break that zone. It's either it will break above it or it will tap into it, thereby taking you out. So that's basically about supply and demand zone. So let me take it back to the initial setting. You can see if we had seen this short earlier, this second trade would have been in profit by now also. So that's about supply and demand zone. Like I said before, let me do a summary, a recap. A bullish order block is the last candle before the drastic push to the upside, and there must be a gap between the highest point of the first candle and the lowest point of the third candle, leaving a price gap on the middle candle. The last candle before the drastic push to the upside is the last candle before price started going up to the upside is what you use your rectangle tool to mark as your order block. And there must be a price gap between the highest point of the first candle and the lowest point of the third candle to that's an imbalance the market to come to fill. And there should be a liquidity, a swing low or a swing low or an equal low liquidity around the order block. The market will come down to sweep, fill the imbalance, tap into your bullish order block, and reverse to the upside. And your order block must lead to your bullish order block must lead to a change of character or break of structure. So that's that for bullish order block. Then for bearish order block, such as in this scenario, it is the last candle before the drastic push to the upside, the last candle before market started going downwards to the downside is what you use as your order block, which is the last candle, the highest point and the lowest point of the candle is what you mark as your order block. And there must be a price gap between the lowest point of the first candle and the highest point of the third candle. There must be a gap between the two, leaving a space on the middle candle, and it must lead to a change of character or break of structure. In this scenario, it led to a change of character here, which made us to believe that yes, this is truly a bearish order block. And we saw this swing high liquidity there intrigued some sellers and some traders to sell from that zone. Stop losses above that zone. He took out their stop losses and used it as liquidity to move price downwards drastically. So that's just it about supply and demand. I believe all the way down to this video you might have been getting some insight and understanding about it already. So that's all for supply and demand. The next video will be talking about how to set break even and how to set multiple take profits.